Hi, everyone. Listen, I know how challenging it is sometimes to be a disciplined long term investor. We're in a period now, in fact, where the stock market has been slowly trending lower for the last few months. It may not feel like it, but these times are completely normal and have happened over and over again. Today, I'll share three charts every investor should know to gain confidence and perspective during uncertain times. Unless you follow the markets closely, you may not know that the S&P 500 is still hanging on to a reasonable gain this year. And this current correction we're experiencing so far is smaller in magnitude than the average year. I'll show you that by looking back on negative headlines, geopolitical risks, and of course, Washington dysfunction, it's easy to see that these issues have been part of the investing landscape since the beginning. Let's get started. Whether you're investing to stay wealthy or you're actively saving to become wealthy, having an allocation to stocks in your portfolio has produced inflation-busting returns over time. The trade-off, of course, stocks come with larger price fluctuation than bonds or cash. This chart here shows a $1 investment in various asset classes, including inflation, between 1926 and 2022. Stock investors put up with sharper zigs and zags over this time frame, but have been rewarded. By taking on the inevitable risk that comes with equity investing, both U.S. large cap stocks and small cap stocks averaged 10.12 and 11.77% per year. On the flip side, a long-term investment in Treasury Bills, think cash, money markets, has barely kept up with inflation, averaging 3.24% versus 2.94%. With elevated yields in money market accounts right now, it's tempting to want to stay away from stocks, but that has not been an optimal strategy. To be clear, it always makes sense to keep emergency fund or any dollars you know you'll need in the next 3 years in savings or money markets. But holding 100% cash or even a high quality bond portfolio for the long term has proven to significantly diminish wealth relative to stocks. There's been no better inflation beater than stocks over the long term. Now, you might say, I know, Brian, this makes sense, but aren't things different this time? We've got an unfortunate war in Israel, another in Ukraine. It feels like political discourse and dysfunction are at all-time highs. And it feels like we're teetering on the verge of recession. Despite what you may think, there have always been reasons to worry. There are always reasons not to invest in stocks. And if you think what we're going through is bad, just look at some of the historical events the market has been through and still climbed higher. We had a sitting president, Richard Nixon, leave office in the middle of his term in the 1970s. We've been involved in several wars in the Middle East. There were the tragic events of 9/11, Lehman Brothers bankruptcy during the financial crisis, the COVID pandemic, and on and on. Despite all of this turmoil, the economy and the stock market has pushed forward. A $10,000 investment in the S&P 500 in 1970 grew to over $2 million by the end of the first quarter 2023. One of my favorite sayings, which it appears some credit is due both Colin Roach and Warren Buffett, the stock market is the only market where things go on sale and all the customers run out of the store. In this case, every past risk was actually a great opportunity to add stocks to your portfolio or rebalance. The other takeaway from this chart is that sometimes stocks go down. Sometimes they go down a lot, and then they eventually stop going down and ultimately resume their march higher until next time they go down and recover again. I wanted to share my favorite chart for today. This gives some really good perspective on what investors should expect as a normal experience in any given year, at least in the US stock market. The blue bars represent the total return for the S&P 500 each year since 1990. The red triangles show just how much the S&P was down at its maximum in each of those years. And the gray dashed lines show the average annual return and the average intra-year decline. Not only are downturns in the stock market common, but they should be expected. As you can see here, the S&P 500 is down during any given year, by an average of 15% since 1990. Yet in 26 of these 33 years, almost 80% of the time, the S&P 500 still finished positive for the calendar year. This, of course, is not including 2023 because it's not over yet. The last thing to realize is that the average return over this period has been 11% per year. But only one year, 2004, did the S&P actually return 11%. It's okay to be concerned about market turbulence, but it's also okay to just ignore it as long as you've created a portfolio geared toward achieving your long-term goals and risk tolerance. We've talked mainly about stocks today since they grabbed the headlines, but we believe a customized mix of globally diversified stocks and bonds gives most investors the best chance of realizing long-term investing success. I'll close with 3 things you can do right now if you're feeling uneasy about these fluctuations. 1, turn optimistic. Ask, how could I potentially benefit from this? If you're holding cash over and above your emergency fund or short-term needs, it may be a good time to deploy that into your portfolio. Number 2, tune out the negative noise and negative people. They just want to get a rise out of you. Number 3, tune into your goals. Why are you investing in the first place? Is it to build wealth for a comfortable retirement or to put your children or grandchildren through college? Are you in retirement and you'll need growth over time so your assets and income keep pace with inflation? Well, thanks for tuning in, and please reach out with any questions.